What's going on, everybody? Welcome into another live stream here with the Everyday Growth Advisors. I hope you're having a good morning. Welcome. We have some quick little updates for you this pre-market. We're going to be talking mostly about earnings and also CPI. Hope you guys are ready for this little pre-market session here. So let's jump right into it. Once again, if you have any tickers that you want me to break down, go ahead, drop it down in the comments, and I will get to it right after I'm done with the breakdown. So yesterday we had CPI numbers that came out, and they were pretty, well, I think it was the day before yesterday. Well, either way, we had in the past 1 to 2 days CPI numbers that came out that were really hot, right? And the market's reaction to it was quite bleak if you think about it. And there's really two trains of thought here. There are two ways to look at this scenario, if you will. The first scenario is that the day prior we priced in majority of what was expected of the CPI number, and then of course the day after we had a very small move down in respect to where we were after the CPI numbers came out. So the small blip down was pretty much just a condensation from what happened the previous day. That's one of the explanations for why the market didn't react with CPI numbers. And then there's two outcomes for this situation. The first outcome is that the 9.1% inflation or CPI number that we are seeing is being kind of inferred by the market as a top CPI number. That means the peak CPI number. And the market is, thinking of it as a bullish scenario. So if you look at the NASDAQ in comparison, you'll be able to see what I mean by this. The NASDAQ has been performing quite, positively compared to the S&P 500 with this with the CPI numbers. And the S&P 500 here underperformed a little bit yesterday, trapping some bears in this break of the 3741, which was one of the regions that I was watching the day prior. And then we're trying to also reject on the 3811 today. So we're really going to be playing between these two pivots today to see what happens next, right? Playing it pivot to pivot is definitely the best way to go by in this market for day trading. Instead of relying on some kind of an indicator or something like that. So remember, one thing about CPI numbers is that they are lagging, right? So the CPI numbers that came out just yesterday or the day before, they are for the past month. They were for June, and so the market's kind of thinking along the lines of if inflation is truly at peak here, then there is a likelihood that the Fed will slam the brakes on hikes, but of course I don't see that as a possible scenario here into this month or the next month. But what the market is pricing in here is a pause in rate hikes, or a pause in monetary policy being hawkish, and that's one of the reasons why tech was favorably trading in the past 1 to 2 days. Now, of course, we are looking at this with a big caveat and a big assumption that these are the scenarios. But remember that in all, we're still waiting for confirmation from the charts and the price action to tell us exactly what is going on. But we are also seeing other signs that this market is ready to cool down a little bit and for prices to normalize to the upside a little bit. One of the things that I'm looking at is the dollar index receding from the 109 level, which we were talking about in the previous live stream session, right? And I spoke about how 109.619 is going to be a key level for the dollar to reside, or rather pull back from. And that's exactly what we are seeing here. A little bit of a pullback here, and this should also cause a little bit of normalization in the price of gold, which we saw kind of sell off all the way down to 158.50 yesterday. We also saw commodities suffer as a result these past couple of months, or rather this whole month of June into July. You can see that oil prices peaked out. XOP is one of the proxies I'm using for oil and gas exploration. Peaked out roughly around 172, and now kind of forming this little downward pressure that we're seeing into this trading session. So there's a lot of things to consider here moving into these next trading sessions. Remember that today is OPEX, and so options are going to be expiring. Likely to see a lot of volatility, but choppiness more than likely. A lot of the open interests that are massive are going to be taken into big swings today, more than likely. It's a typical day for market makers to spoof the markets and try to get as much done as possible in terms of covering any delta longs that they have or delta hedges that they have. And that's going to be something that we'll be watching on the Discord today. So that's with CPI numbers. As I said, recap 2 scenarios. First scenario is that peak inflation is being priced in here. And second scenario is that that we are going to see further downside. Now, of course, I'm not saying that the S&P 500 is going to zippity zip all the way up to $4,000 like right away or something like that. I mean, it could take a little bit of time to get there, but I do think that we're squeezing into this little focal point here, and I think that eventually when we do break out of here, it's going to be a massive squeeze into the 4,000, depending on how much of short pressure there is. The more shorts that start to pile into the S&P 500, the more bigger the short squeeze is going to be as the shorts start to unwind, and that's what I'm kind of hoping that happens. As a result, you can see some of these favorable names that are popping up. NVDA is one of them that I'm watching pretty closely. Above the 155, 156, if it can kind of break above and start bouncing on this level, then I'm going to be bound to take some upside positions into the 160 or 165 even, or even 170 based on how I see the upside exposure. And then Marvel Semiconductor also breaking out here. This is going to be a top watch for me today personally, as well as Apple, which is on the key pivot point here. It could run up to 151 or so if we get that bullish momentum and cadence on the indexes. So we really want to see that bullish cadence on the S&P 500 before we really take any of these trades. We're going to play it very close to the vest. Another one that I'm looking at is TTD. This has been on a downtrend for a very long time, and it's squeezing really hard here. It could pop if it doesn't break below the 39.61 level. We saw that brief breakdown and then a quick buy up, and so we are expecting this to move either way in this trading session, or at least by the next week. So we'll be watching this one pretty close. This has been a pretty solid support for TTD. Also in other news, Walmart here breaking out of a ascending triangle. This is another one that we've been watching, and we want to play this at the upside, but we're waiting for the right moment to get in. If you saw Costco, we spoke about Costco. And Costco actually broke out and hit our first and second target. This was on the snipe list this week on the Discord. And so we have been watching these setups for a little while. So in case you're curious what we were watching this week on the Discord, which is posted every Monday, we were watching Enphase Energy, Tesla, Costco, McDonald's, and XOP. Now that the week is over, you can have a look at all of the trades that we were looking at, and majority of these setups already made their moves, so that it's all kind of over, and we're going to get a new snipe list today. We're going to be playing only 0-day expiries, which will be mainly volatile stocks that will be moving, so that's another thing to look at. Okay, so first 10 minutes done. I hope that CPI explanation was somewhat helpful for you guys. Now let's talk about earnings a little bit. We have some of the banks reported earnings, and I'm going to kind of go through a couple of them. The first one I'm going to go through is JP Morgan. And JP Morgan reported earnings, I believe, yesterday. And so here are some key highlights. Now, I know, I think that the news sensationalized this as a bad earnings beat. They still had a net income of $8.6 billion and EPS of 2.76 per share, managed revenue of $31.6 billion, and then expense of $18 billion. But we really want to see the individual breakdown. So let's look at some of these here. Consumer and community banking. So JP Morgan breaks it down per sector of their balance sheet, and I like this. We can read the financial performance here of each sector, which is actually kind of nice, and they kind of explain everything too, so it helps you kind of understand. If you're a person that doesn't know how to read, things like this, or if you don't understand all these terms, then just read this part of it. It's just so I think it explains everything a lot easier. So net income of 3.1 billion versus 5.6 billion in the same quarter last year. So net income is down, reflecting the absence of credit reserve release recorded in the prior year. So last year, remember, after COVID kind of happened, remember that the Fed was requiring a higher credit reserve from banks, and after COVID stabilized, the banks were allowed to release their reserves. And so their reserves were much higher last year, which allowed them to use a lot more cash to generate more income. Remember, the more money that banks have, the more money they can make. And now that reserve requirement has gone down. So, they're talking about the net income going down, reflecting the absence of the credit reserve from last year. Okay, so you need to understand why net income goes down. It's not only just important to say, oh yeah, net income went down, so the bank is underperforming. See, that's a very terrible way. You got to actually go and read these things to actually find out what's going on, right? Because if you don't, then what are you actually doing? Like, what are you actually trying to get at, or what are you analyzing, right? So read these earnings reports. They give you a lot of information. So revenues down of 12.6 billion, and then down 1% year over year. It doesn't sound that bad, right? 1%, that's not bad, right? Expense of 7.7 billion, up 9%, driven by higher investments and structural expense, partially offset by lower volume and revenue related expense. Okay. Credit costs of 761 million, net charge-offs 611 million, down 121 million year over year, driven by card. Reserve build of 150 million, so they're building reserves for card, driven by loan growth. So the loan side of the business is funding part of their reserve. Okay, you can read all of that, right? Okay, so then moving in, this are like key driver statistics. If you don't really want to get into all of this, this should be enough to tell you the financial performance of just consumer and community banking, right? Then you have corporate and investment banking. And net income here is down 3.7 billion, down 26% year over year. Now, this sounds a little worse than usual, right? Revenue of 11.9 billion, down 10% year over year. So net income is down pretty big. But remember, once again, this is because their reserves are lower, right? They don't have that many reserves. And then banking revenue, IB revenue, investment banking of 1.4 billion, down 61% year over year. Remember last year, JP Morgan had a killer year because they had all that reserve release and they could use all that money to kind of bet on the market, right? And they did it, right? And then payments revenue of 1.5 billion, up 1%. Lending revenue of 410 million, up 79% year over year, driven by mark-to-market gains on hedges of accrual loans and higher net interest income. So a lot of people borrowing money and paying a lot more interest in for their loans, right? And then you have markets and securities services revenue. So markets revenue 7.8 billion, up 15%. Fixed income was the main one here, right? Driven by strong results in macro businesses, partially offset by credit and securitized products. And then equity markets revenue 3.1 billion, up 15% year over year, driven by strong performance in derivatives, so options, right? Lots of options trading. So that's $3.1 billion in revenue from equity options, right? That's pretty sick. Securities services revenue of 1.2 billion, okay, expense of 6.7 billion. And then you have commercial banking, once again down. And then revenue about 8% up, expenses 18% up, credit cost, average loans, average deposits up by 4% year over year. This commercial banking is obviously one of the things we want to look at. And then we have asset and wealth management, net income 1 billion, down 13%, and then revenue 4.3 billion, predominantly driven by growth in deposits and loans on higher balances and margins, partially offset by investment valuation losses versus gains in prior year and lower performance fees. Then you have expenses, AUM. AUM is assets under management of 2.7 trillion and client assets of 3.8 trillion, down 8% and 6% respectively. So more assets pulled out of their wealth management. Predominantly driven by lower market levels, partially offset by continued net long-term inflows. Okay, and then you have AUM net inflows of 6 billion for long-term products. Okay, average loans and average deposits. So these are all important things to watch here. And then you have corporate, not much going on here, and that's JP Morgan. So all in all, sounds like a pretty terrible quarter, but you have to realize why their quarter went the way that it did, and then we also have to see how the effect was on the stock price, right? So you'll realize that yesterday JP Morgan announced earnings, and then the drop was pretty drastic, but then it got bought up almost instantaneously. And you know what? This today, it's not doing as bad now. So it does look to me like a lot of this price action was priced in already prior to it, kind of reporting earnings, and so the market didn't really react super unfavorably. But that's just obviously something that we have to, keep in the back of our heads. So that's JP Morgan, okay? So a little worse than expected earnings results is what I'm seeing here. A little worse than expected. Then you have Morgan Stanley. And here reported net revenues of 13.1 billion for the second quarter, compared with 14.8 billion a year ago. So a little less net revenues. Net income applicable to Morgan Stanley was 2.5 billion, compared with net income of 3.5 billion the 1 year ago. So once again down further because of various different reasons. So this is the CEO and chairman's kind of blurb. Overall, the firm delivered a solid quarter in what was a more volatile market environment than we have seen for some time. Strong results in equity and fixed income helped partially counter weak investment banking activity. We continue to track positive flows across our wealth management business, and investment management continues to benefit from its diversification. Finally, we finished the quarter in a strong capital position to ensure we move forward with confidence. So obviously, he's going to put together a very nice statement, right? Hey, you can hear me, right, guys? If you can hear me, can you just put a quick thumbs up in the chat? Just make sure that you guys can hear me, because I think it said that my connection dropped for a second. I hope it's smooth, the connection. If you can hear me, please put a thumbs up in the chat or say something. Okay, cool. Thank you. Okay, so and then you have the firm reported solid results, right? Let's see here. So the main thing here, firm's expense efficiency ratio impacted by regulatory matter concerning the use of unapproved personal devices, something like that. They lost $200 million for that. That's kind of crazy, right? Firm remains in strong capital position with the standardization common equity tier 1 capital ratio of 15.2%. And then institutional securities net revenues for 6.1 billion. Was strong performance in fixed income and equity as clients remain engaged in volatile markets while limited activity in investment banking. So you guys need to remember Morgan Stanley, JP Morgan, Goldman Sachs, they are 3 investment banks, and they make a lot of money by investment banking or making deals, right, for other people. So Morgan Stanley didn't do as well. JP Morgan did better. You can see from their earnings reports, right? And then let's see here, wealth management, once again associated with certain employee deferred compensation plans. Business added new assets of 53 billion in the quarter and 195 billion in the first half. This is also interesting, right? So they continue to see money going into the bank, but despite that, their earnings wasn't as great. So you can take your time to read this entire report. But once again, sounds like Morgan Stanley also struggled through a quarter that was kind of tight, right? Okay, next one. Wells Fargo Chase. Wells Fargo Chase also had a similar problem. Results included 576 million impairment of equity securities, 412 million, and then predominantly in our affiliated venture capital businesses driven by market conditions. So they lost almost $500 million in some venture capital businesses. Revenues of 17 billion, down 16% once again. Mortgage banking, non-interest income down $1.3 billion. Business divested in 2021 accounted for $589 million. Wells Fargo had a pretty terrible earnings report, right? So we're seeing a trend and a pattern here. A lot of these banks are underperforming. And, as I've said, when the earnings season comes around, you really want to see how these banks are performing. It's really going to set the tone for the entire earnings season. So now you can go and read this entire earnings report, but I'm just giving you the highlights of what these banks are kind of reporting and where we are at with these. And then the last one, I think the report that just came out this morning, which was the one that shocked me, was Citibank with a pretty damn big beat, right? I think it's the only bank so far that beat. And they had a pretty, not a small beat, it was a pretty big beat too. I think they beat by $1.32 billion. So revenue was up 12.4% year over year. And they beat their EPS by 52 cents. So there was a positive surprise there. And then we also need to look at, obviously, their full report here and kind of break down everything. But on the cover, I haven't read this whole thing. On the cover, it looks like, they did a pretty good job. So CEO commentary once again. While the world has changed since our investor day in March, our strategy has not, and we are executing it with discipline and urgency. Treasury and trade solutions fire on all cylinders as clients took advantage of our global network, leading to the best quarter this business has had in a decade. Trading volatility continued to create strong corporate client activity for us, driving revenue growth 25% in markets. That is pretty big, right? While economic sentiment clearly impacted investment banking and wealth management, we continue to invest in these businesses, and we like where they're headed. In U.S. personal banking, the positive drivers we saw in our 2 credit card businesses over the last few quarters converted into solid revenue growth this quarter, most notably a 10% growth in branded cards. In a challenging macro and geopolitical environment, our team delivered solid results, and we are in a strong position to weather our uncertain times given liquidity, Okay. So, net income decreased 27% from the year prior. So once again, all these banks underperforming pretty much in terms of the net income, because they don't have as much reserve to do what they would. And remember, with monetary policy getting tighter, they will have higher demands for on-balance deposits and stuff like that, and they will have tighter credit. So they have to tighten their books in order to get in line with the monetary policy. So you can see the theme. The theme with financials is they are all kind of waning in the same way, and that's one of the things that you need to keep in mind going into this next week. Now that banks have reported and they underperform, we are likely to see some of big tech underperform as well and guide downward. We didn't see much guidance from banks yet, but I think that will be more reliant on the Fed's decision on interest rates, which we are expecting a 75 basis point rate hike in the next meeting. I doubt that they will do a 100 basis point rate hike, but we'll see what happens anyway. So the S&P 500, if it can and continue to form, bullish momentum here, then we will see a retest, obviously, of the 38.74, maybe end of day, hopefully. And if we break above that, then 39 to 4,000 infinity and beyond is what we're likely looking at, but not without pullbacks. We'll definitely have some pullbacks along the way, and that will be something that we'll be looking at for next week. So far the squeeze continues, and we are seeing majority of possibility in inflation kind of being priced in here, like peak inflation being priced in, and the rest of it should be pretty explanatory when the Fed comes in with its new data sometime at the end of this month. Okay. I'm ready to take some tickers. Do you guys have any tickers that you want me to break down? We have about 5 minutes left, so I want to make sure that we get any requests done over here. Thanks for liking the stream, guys. Appreciate it. Smash the like button. I do appreciate you guys, taking the time to be here and just attending this live stream. Was also watching Zoom here for a potential bounce today. Let's see what happens, but if we can get it above $100, then we can potentially see 105 again. That could be a possible bounce scenario. Tesla is in a terrible spot to trade right now. The risk to reward ratio is terrible on either side, so I want to avoid trading this right now. And Roblox is another one that I'm looking at as well. This will be a potential upside trade with a very defined risk off below $36 or so. This is another good one. Lots to watch here into the open. And yeah, keep your eyes on the dollar. The more it recedes, the better it is for equities. And that should continue to be the theme. All right, I don't see any tickers. You guys, I'll just wait another minute to see if you guys need me to break down anything else. Just a quick little consensus here. Was the explanation on inflation and earnings helpful for you guys? Great. I'm glad that it could be of help to you guys. All right. Well, I don't see any ticker breakdowns required here. I'm going to go ahead and end the stream. I'll see you guys back on Monday, of course. We'll be talking about earnings once again, more than likely. We'll see what the projected earnings are. Maybe I'll have some earnings bets ready for you guys. But till then, take care and trade safe. Have a great weekend, and I'll see you all back on Monday pre-market. We'll do this all over again, and we'll look at where the market hits from here. I'll see you on the Discord for those of you who are trading live with me. And yeah, peace. Take care.